hedge fund that is heavily invested in the TSX and is net long, maybe like let's just say 90% long in resources, then the TSX may be a fair benchmark when it comes to gauging performance. However, if we look at a market-neutral fund or a fund that hedges and is supposed to produce absolute returns year to year by hedging and being more conservative, then when in good markets they will always underperform the TSX when the TSX is up 30%, and they will outperform the TSX when markets are down. And so when it comes to a hedge fund that does hedging and is supposed to produce solid conservative returns in the range of 10%, the risk-free rate of return plus 3%, for example, might be an appropriate benchmark. So it is very difficult to gauge the right benchmark when it comes to hedge funds, and we need to be really careful that the benchmark that we pick matches the strategy perfectly. And so one of the generic gauges that we have for hedge fund performance is the Sharpe ratio, because it incorporates standard deviation or volatility. The formula itself is return minus, so the total return on the hedge fund minus the risk-free rate of return over standard deviation. So I will give two examples here of ABC and XYZ hedge funds that both returned 10% in 2008. However, ABC had a 5% standard deviation, whereas XYZ has a 25% standard deviation. So in this example, we're going to assume that ABC's band of returns is pretty narrow, between 8 and 12%, so very consistent, whereas XYZ had returns that range everywhere from negative 25% to 40%. And so therefore, their standard deviation is much higher at 25%. We're going to assume for this formula here that the government T-bill rate is 1% for our gauge for risk-free rate of return. As you can see, we calculate ABC's Sharpe ratio and it's 1.8. XYZ's Sharpe ratio is 0.36. So even though they both return 10%, the Sharpe ratio was much preferred on ABC because of the lower volatility and the narrower band of performance. So the Sharpe ratio is a good gauge of hedge fund performance. We run the Sharpe ratio in our quarterly report, and we have all the calculations underlying in the report, and we've been calculating from 94. And looking at annualized returns from 94 until end of 2008, the Sharpe ratio for our hedge funds on an average is about 0.6, whereas 0.09 for the TSX. So from a Sharpe ratio perspective, the hedge funds have outperformed the TSX index as a whole with higher return and lower volatility. This is not directly related to hedge funds, but I thought this was an interesting picture to show you in terms of the subprime debacle. The reason why I have this slide is because the subprime crisis really played a large role in a lot of the volatility in the markets that we have today. Our traditional model in terms of bank lending, in terms of mortgages, is a bank collects deposits from customers, they take those deposits, and they lend them out to borrowers for mortgages. So this was the world that we lived in years ago. 2000, and we had the tech crash. After the tech crash, investors were looking for new investments, and real estate was regarded as safe haven because of the bricks and mortars, the land. And so what happened through the tech crash was a little bit of a fuel of the real estate bubble. And people had to get very creative to do this. And as what we were seeing was a lot of people in the U.S. and other countries were not only buying homes for the purposes of living, but buying for investment opportunities as well and renting them out. So the real estate market was growing significantly, and the bankers had to get a bit creative to expand this market. And so let's look at today's reality and how this all worked out. We have mortgage brokers now, which is a large component of how mortgages get originated. But they go out and they try to sell mortgages to borrowers. Then they go to some of the local banks that provide funding for these mortgages. In order to free up their balance sheet, the bankers would sell pools of mortgages to aggregators on Wall Street. So some of the large investment banks like Citigroup, Bank of America, would package up a pool of mortgages into residential mortgage-backed security, get it rated AAA by the rating agency, and sell it as an investment, which attracted a lot of international money. To make things even more complicated and to expand the market even further, we had CDOs, which is kind of like a mutual fund of bonds, and that you could package 100 residential mortgage-backed securities into a jumbo bond worth billions of dollars. And this really facilitated the growth, allowed the subprime market to grow. With so much money coming into the U.S., they were able to offer mortgages to borrowers that shouldn't have really been borrowing, in terms of unemployed people, people that have defaulted in the past. And finally, you have the end investor that was fueling all this. and they were investors from U.S., Canada got some of it through the ABCP crisis, Japan, Australia, UK, everybody helped fuel this real estate bubble in the U.S., which bursted. And as you can see from here, from borrower to investor, there's about 5-6 degrees of separation. The end investor really, at this point, after going through so many layers, did not really understand what they were buying, and this is what helped fuel the massive real estate bubble that bursted. We're going to go into a couple more concepts here into the hedge fund world, and let's talk about short selling. Short selling is something that hedge fund managers engage in when they believe a stock is about to go down. So when they believe a stock is going to go down, they sell it first in anticipation that they can buy it back at a later time at a lower price. So we'll walk through a simple example here. An investor sells 100 shares of ABC stock at $10 short in anticipation it will go down. So up front, the investor gets proceeds at $1,000. Now let's look. What happens if ABC drops $6 as anticipated? Well, the investor decides to buy back at a profit. So the investor will buy 100 shares at $6 for $600 and therefore has earned a profit of $400. On the flip side, if the stock goes up, which is not what the investor had anticipated, the investor will have to purchase 100 shares at $14 and therefore will have to pay $1,400, which results in a loss of $400. Now, the biggest question, I think, in 2008 was, why didn't hedge funds do more short selling? And the reason is because, in a nutshell, short selling takes guts. As you can see, short selling has a very limited upside, unlimited downside. In the case of short selling, the maximum that you can make are the proceeds that you get from your short sale. If the stock goes to zero, you made $1,000. But what if ABC stock went up to $50, $60? So basically, the concept here with short selling is that the downside is infinite. Now let's talk about margin. A lot of some of the key phrases I've been throwing around is leverage, deleveraging, and so let's spend a minute here on leveraging. And this is essentially borrowing to invest more proceeds. And so the example that I have used here is that the investor purchases 100 shares of ABC at $10 and borrows an additional $1,000 in order to invest more. And so in this instance now, the investor owns 200 shares of ABC, of which half the proceeds were put up by the investor and half were borrowed. And so the investor, let's just say the ABC stock drops to $6, which is a 40% drop in the stock. The investor sells 200 shares at $6 and gets total proceeds of $1,200, and then the investor returns $1,000 to the bank and only recovers $200. In this case, because the hedge fund leveraged, the hedge fund ended up losing 80% on the investment rather than the 40% in the stock. So as you can see, it can magnify losses, but on the flip side, it can also magnify returns. If ABC stock had increased to $14, which is a 40% gain, the investor would have recovered $2,800 from the sale, given back $1,000 to the bank, made $800, and returned 80%. This is a simplified example and obviously does not include borrowing costs. There would be borrowing costs associated with a transaction like this, but to simplify, we left those out for now. But as you can see the attraction of leverage in that it could really grow returns exponentially. And this is why hedge fund managers do deploy this strategy. Another concept that's talked about a lot is alpha. And you might hear someone say, wow, that hedge fund manager generates a lot of alpha. That's not to insinuate that the hedge fund manager is an alpha male. There is a different meaning. And basically, it's the premium return above the risk-free rate. And so to give you an example, a numerical example here, we assume the risk-free rate, again, is 1%. And in this case, the hedge fund manager returns 4% in 2005, 5% in 2006, 6%, and then 4% respectively. All those returns above the 1% risk-free rate are considered alpha. So basically, when you hear a phrase like the manager produced a lot of alpha, it really insinuates that the manager has